All right, my friends, so let's take VTSMX and rebalance with VIPSX. That's what we'll do here. Let's get that up a little bit. That's what we'll do here today at the Heritage Wealth Planning YouTube channel. The last time we did it, VTSMX and VIPSX combined looked good relative to the VFINX and VIPSX. So what happens when we add a little bit of annual rebalancing? So stick with me. Don't forget to subscribe down below. And as always, comments, thumbs up, the whole thing. The longer you watch, the better you help your old buddy Josh. So stay tuned. If you skip out too early, YouTube doesn't like that. So watch as long as you possibly can. All right, so let's dive right into this, my friends. So again, VTSMX is the Vanguard Total Stock Market Index, which consists of what? It consists of 70% of VFINX plus the extended market index, which is the Wilshire 4500. So essentially you're getting the entirety of the U.S. stock market in this one fund. VIPSX, again, is the Vanguard Inflation Protected Securities Mutual Fund. And because VIPSX was founded in 2001, is actually the latter part of 2000, but we're just going to use 2001 going forward. And that gives us a nice number of years we can look at. So again, we're starting with $100,000, but we're putting $50,000 into each, all right? Then after the first year, what happens is we're just going to rebalance it to be, it won't be 50, well, it'll be 50%, not 50,000, 50,000. So it'll be 50% each. So let me give you an example. After the first year in this case, because the market was down, let's see what we got. Boink, there we go. So after the first year, the VTSMX, the 50,000, was down to 40. Was down to now I can't read my own handwriting. So basically, at one point, it was down to 36,913 in year two, and then this guy VIPSX was up to 54,487 because of the market decline in 2002. And so what we did was just rebalanced them, and then the following year, VTSMX was up to 57,026. And this guy was down to 46,888. So all we're doing is we're saying, so at the end of 2002, 36,913 and 54,887. We're rebalancing it to I can't tell what that is. So that if you add those two together, it's 91,400 divided by 2. And then the following year, this was at 57,026. This was at 46,888. You add those two, is 103,914. Divide by 2, and that's how we're doing this. I hope that makes sense. I mean, I did my nice little spreadsheet here. So essentially, that's when the one goes down, the other goes up, hopefully, which is exactly what happened here. We're taking the gain from the other and putting the losses on the other. That's how we're working it, and we're doing 50-50 across the board, and we're taking 5% at the end of the year from the entirety of the portfolio. And what we find is we got 4916, 4570. So at the end of two pretty dastardly years, we have $86,000 left. So we did take a 14% hit and a 13% hit, and we're able to take out roughly $9,500 in cash. That's not so bad. They keep going. Now we're back up in the black. We got 103 here. We were able to take out 54.49. Fell back a little bit in 2005, not because the markets fell so much, but because the markets didn't give us enough to compensate for that 5% return. So remember, I am taking 5% a year off. So then we go down to 2007. We're taking 5710 off the portfolio, which is pretty good. We have a portfolio balance of 108,482. Again, we just divide by 2. So whatever that balance is, 108,482, we divide by 2, and that's what each side has. But then we got hammered, and now we're down to 82,503 total. And that's not good. So we dropped our income from 5710 to 4342. Then the next year we had an up year. We're back up to 93,857. And then we finally, in 2011, we got back to over 100,000. So we're at 101,271. We're still snug as a bug in a rug at 5330 for our income stream. 2015, VIPSX got hammered. VTSMX didn't do much, but our portfolio value fell from 117 to 110, and our income fell from 61,830 to 58,229. We're still doing pretty good though. We still got 10,000 above our initial $100,000 deposit, and we're taking 58,29. That's not too shabby. And then look at the end of 2017, we're left with 121,000, taking off $6,390. That ain't too bad, man. That ain't too bad at all. And relative to what it was without rebalancing, and you can't see all this, but without rebalancing, we were able to Did I lose my? Phew. All right, so with rebalancing, we had a total income of 92,706. Let me write that down. 92,706. That's what we took. We have 92,706 with an ending portfolio value of 121,417. So I mean, basically, we start with 100. We got well more than 100,000 left in our portfolio, and we almost got a full $100,000 in cash too. Now, when we didn't rebalance those, we had 89,340 here, and we had an ending value here of 112,684. So the rebalance gave us about 3,000 more in income, about 3,500 more in income, and about 9,000 more in cash. So rebalancing really paid dividends for us. So let's go back to the S&P 500 and see what we're looking at there, if I can. I'm sure I'm not going to be able to find this while you guys are listening to me yap here. Yeah, let's see. Hold on just a second. Do I have that? Yeah, here we go. Rebalance, cool. With the S&P 500... Yeah, I'm not going to be able to figure out, well, oh, here we go. Without rebalancing on the S&P 500, we were left with 107,000 here and 86,000 cash. That's without rebalancing on the S&P 500, the VFINX, and the VIPSX. So the VTSMX has just dwarfed. I don't have rebalancing here. I thought, yeah, I did. Well, that's... Can't tell what I use there. Okay, I can't, I'm not sure what I used in that. All right, so I'm not going to. All right, so anyway, at the end of the day, what happened here? There's three things going on. The VTSMX and the VFINX. Which was better? Bar none, the VTSMX. So of the two funds to use in conjunction with VIPSX, the VTSMX absolutely made you money with similar to a little bit less risk, not much, but not a huge amount of risk there for sure. Certainly not more risk, that's for sure, over these last 8, 16, 17 years. So you made more money from income stream. Here we're left with $63.90 as an annual pullout, where we're able to pull out, and we still left with 121. Nothing else came close. The second thing on these 4 scenarios actually, would be VTSMX and VIPSX without rebalancing. The third thing would be VFINX and VIPSX with rebalancing, and the fourth would be VFINX with VIPSX with no rebalancing. So 4 different scenarios, VTSMX and VIPSX with rebalancing smoked all the comers. It smoked it. The worst case scenario, and this is pretty bad. I mean, we're down $26,000 here, and again, this is rebalancing in 2008. That's a pretty significant decline, my friends. And we're talking 108 minus 82 divided by 108. That's a 24% hit. That's not chump change right there. That's a 24% hit. We lost $1,400 a month in income, but we're able to make $63.90. I mean, that's $500 a month. Let me go back to what the last month that we had without rebalancing last year was 63. It was 59.31. So the last year when we didn't rebalance was 59.31. I mean, again, that's a $400 a month difference. With the S&P 500, that we were pulling off 56.64. I mean, so you're talking. I mean, we're talking big money here. We're talking $700-800 a year. I mean, that might not seem like much, but I mean, if you're on Medicare and Part, I mean, it's not quite your Part B, but your Part B is 134. That's getting close to you're tired of your Part B. Not 100%, but that has a value there for sure that you could use to spend that you couldn't get if you didn't rebalance or didn't have the VTSMX. All right. So what's going to happen as we go forward? I'm looking at right now. We're going to use probably 8-9 more funds to show you how you can do this kind of thing here, but to keep it simple. Because remember, this right here would require you to say 86,830. I have to pull half, basically divide that by 2, which would be what, 43,000 roughly, 43,415. Sorry, at the end of 2002, you have to have 43,415 and put into both. I mean, who's going to, will you do that? The vast majority of people just won't. But that's what this would require you to actively do that. say I got 86,830, I'm going to take 5% off, and then I'm going to take the rest and divide by 2 and put it into both sides of the equation, half and half. No one's going to do that. And it's just a rebalancing. While it sounds good, no one does it. I'm just telling you right here, no one does that. At least they don't do it with any specific specificity, like on the 1st of January or the 16th of June. No one ever does that. They do it when they feel like it. And so if we can find a way to avoid that, of you having to take charge and yet get the results of a good portfolio that's rebalanced, that also provides that growing income stream without killing the bottom line here as well, that's what we're shooting for. And I have come up with something. And so stay tuned, because we're going to do these one by one by one. And you're going to like what you see, my friends. I'm telling you, as we go forward, you're going to like what you see. I'm going to use a bunch of different funds, and not just Vanguard. We're going to use American funds. We're going to use Franklin. Where's the other one? We're going to use a couple of Vanguard actively managed funds as well. So stick with me. Subscribe down below. Thumbs up, comments always helps. So we'll see you next time. Thanks, guys.